I'm Alice Simon, and I'm a very proud member of the Department of Economics and Business as a faculty member and an economics professor. I'm also the faculty director of the Walter Mate Center for Economics, Business, and Entrepreneurship. This is the 14th year that we are helping to sponsor the Economic Outlook Conference, and it is my pleasure to welcome students and faculty and local people in the community and alumni, and it is now my pleasure to introduce you to our president, Dr. Jones.
Thank you, Alice, and thank you to all of you for being here this evening. This is one of a number of programs that the Walter Mate Center for Economics, Business, and Entrepreneurship hosts each year. Lectures that bring to campus individuals with expertise and interest not only to our campus but to the broader community, and other events. But probably the most anticipated event each year is this Economic Outlook Forum that, as Dr. Simon indicated, has been hosted by the Walter Mate Center now for 14 years, and we are thrilled to again have a distinguished group of panelists. There's never enough room on the panel for everyone you might like to include, and I see some former panelists in the audience here as well this evening, and we welcome you back as well. Our moderator for the evening is Dr. Goran Skospels, who is on the faculty in the economics department. He teaches macroeconomics and a number of other courses in the field, and it's a pleasure to introduce Goran now, who will present our panelists, who will present and then engage in conversation with one another, and we hope with you as well. Thank you and welcome. Goran?
Good evening and welcome again to our, I believe this is the 14th annual Outlook Conference. And for the first time, we have a female presenter. So that's a big deal. We were able to find a unicorn. Thank you. Thank you, Deb, for coming. So let me introduce our three panelists. Deb is from Columbus 2020, extensive international experience in both her current and in past roles. She focuses on developing relationships with businesses, especially foreign companies, and bringing them to Ohio. We hear terms such as job creators, and when I saw Deb's resume and when I talked to her, this is what we mean by job creators. She literally brings companies and creates jobs in Central Ohio. We'll hear about what to expect in Central Ohio from her, and I'm really looking forward to it. She's in the trenches when it comes to business development, and we teach our students theory to practice. This is as close as it gets to theory to practice. So I'm very eagerly awaiting to hear from Deb tonight. Mark Schweitzer from the Cleveland Fed has presented to us several times, and his presentations have always been excellent, witty, reasonable, understandable. He joined the Fed in 1992, so for 26 years he's been almost working at the Fed, although he did take a little break, it seems, to work with the Bank of England, back to Cleveland, Denver, Kansas City branch in Denver, then back to Cleveland, and now he is a senior vice president at the Cleveland Fed. Still doing a lot of outreach programs, just like this one, talking to audiences. And he shared that he's still doing actually even more research, so that's good to hear. Economist never dies inside, even though it's more of an administrative role. I'm looking forward to hearing what he has to say, especially about this, what we can expect with this crazy economy. It's tough to follow, so he always sheds good light, and hopefully he does that this year as well. Ian is our resident international trade expert, and sometimes you can find him in the hallways of the Ohio State University, but we claim him as ours. He comes here often, and he's an excellent teacher, an excellent researcher, and just an interesting person to have a beer with and talk about almost anything. Trade is in the news every day, and I'm super looking forward to hearing what Ian has to say. Without any further ado, we'll start, and each panelist is going to present for about 10 to 12 minutes. Then I'll ask them each questions, but they have questions from each other, and then we'll open the panel to questions from the audience. Let the festivities begin. First, we'll have Deb.
So thank you, Goran, and thank you, Ohio Wesleyan University, for including me in your program this evening. I'm delighted to be here. For those of you who are not familiar with Columbus 2020, we are the regional economic development organization working with 11 counties here in central Ohio. Delaware, of course, is one of the counties that we work very closely with and are proud to call partners in the Columbus region. There's really 4 goals that we focus on at Columbus 2020. Those goals are a net increase of 150,000 net new jobs, $8 billion in capital investment, a 30% increase in per capita income, and to become known as the nation's best economic development organization. And I'm happy to report to you this evening that we are very much on track to meet all 4 of those goals by the year 2020. In fact, we're already have met 2 of the 3 major goals and have been recognized nationally as the best economic development organization in the country. So we feel very confident that by 2020 we'll be reaching all of those goals. Just to share with you a little bit about the regional outlook and where we have come from, and then I'll touch a little bit on the end about where I think that we're moving forward to. Since our inception, we've been tracking the region, and the region has seen significant growth. We rank as #1 in the Midwest for job growth. We've grown 20.5% since 2010 to 27, and when we compare ourselves against other major Midwest metros, we're ranking very much in first place. We are also trending #1 in population growth. So during the same time period, a 9% increase. We're ranking #1 in the Midwest for GDP growth at 24.4%, really outpacing many of our partners in the Midwest. And we're #9 when it comes to top 10 U.S. millennial growth. All of these successes, or all of these attributes, are really what's helping contribute to the success of the region and helping us develop and experience major wins. So if I look at this year alone, we have now announced 43 projects that have involved capital investment and job growth in the region. Those projects have committed to nearly 5,000 new jobs in the region, $226 million in additional payroll, $609 in fixed asset investment. We've had 4 new R&D grants that have been awarded in our region, which were R&D projects that weren't, with companies that hadn't previously been doing R&D in the region itself, and we've had 2 redevelopment projects. The reason why I highlight these is while the number of projects for us may be down somewhat, a typical year for us would range in the, let's say, 80 projects a year, the job numbers are significantly higher than where we've seen in the past. If I look at where we will be trending before the end of 2018, we estimate that we're going to close 11 more projects in the region, and those projects will have nearly 3,000 jobs attached to them. That is if these predictions, or if what we suspect holds true, this will be the best year of committed jobs that we've had, certainly since the inception of Columbus 2020, but likely also of any year previously that we've recorded. So we think that we're certainly on the right path. I also think that it's interesting to look at how these jobs and projects that we have won, kind of how they're split out. And so when we say attraction for a project, that means a company that doesn't have operations here already, so they're new to the region. And expansion is companies that already have operations but are expanding their operations. So when we look at that, 66% of the projects that we work on are with companies that are already here in the region. When we also look at the mix between domestic companies and international companies, that split is 82 domestic, 18 international. That international number is down a little bit over previous years. We're normally in the 20 to 25% range. And I think that a lot of what's happening in our global economy right now, specifically with the trade wars and the renegotiation of NAFTA, those have had some impact on companies, specifically international companies that are looking to invest. When international companies come and they look at doing work here, they really are focused on how can they have the least amount of risk involved. And with everything that's been happening, specifically at the federal level, there's not a sense of comfort that things are going to stay in a way in which they feel comfortable making those large dollar investments. Which leads me to talk a little bit about what I would consider, while we have the winds at our backs, I consider there's some hurricanes that are out there. And so those hurricanes would be hurricane tariff and hurricane trade agreements. And so let me take just a few minutes to talk a little bit about that and the impact that we're seeing in the region. So over the past several years, so if we look at 2005 to 2016, specifically in the Columbus region, the percentage of change in exports to China has been significant. We have grown exports to that market over 200%. When I look at the percentage of change in exports to Mexico, it's been 115%. And even Canada to our north has grown 15%. This is a significant amount of activity, cross-border activity that's happening from companies who are exporting products and services from this market. When I look at exports and imports from Ohio, when I look at the top 3 export markets in order, it's Canada, Mexico, China. When I look at our top 3 import markets in order, it's China, Canada, and Mexico. What are the 3 countries that we've had the most dialogue with in the past year and a half? China, Mexico, and Canada. And so changes in any type of activity, tariffs, trade agreements, whatever it may be, have and will have a significant impact on Ohio, in my opinion. When I look at the top 4 export markets, or products, that are going overseas, aircraft engines, motor vehicles, motor engines, and soybeans. The soybean market has been significantly impacted by the tariff implications with China. I mean, essentially, China's not buying US soybeans. And so if that's the top number 4 export product out of Ohio, that's going to have significant impact on our farmers. Top 4 import products, medicaments, returns, chemicals, jet parts, all things that have tariffs now put on them, minus the returns. Certainly those products are coming from China, Canada, and Mexico, and have implications far and wide on the global supply chain, and specifically companies that are operating here. So let me talk a little bit about China-US relations. So when I go out, I'm out talking with Central Ohio companies on a daily basis. And when I talk about their global strategy, I can certainly tell you that tariffs come up nearly in every single conversation. Because we are so integrated in a global supply chain, it is having an impact. And it impacts people both positively and negatively. So if you were to ask me, how is this tariff situation impacting companies? It's really a mixed message. So some companies I've spoken to, you know, their costs have increased $2 million a month because the parts that they're sourcing to integrate into their finished final assembled product, those components are largely coming from China and are facing 25% duties on that product. There are other companies that maybe are in the steel or aluminum industry where, because they're US based, their orders have increased significantly because they are, you know, people are switching their supply chain to purchase locally. And so what's interesting also about that, though, is because the demand is so high, it's causing prices to increase, which is then impacting the companies that are purchasing from them. So cost of goods are also increasing. You know, there's a question, and Ian and I were talking about this a little bit earlier. Does a deal get done at the end of this month with China at the G20? There's been a lot of speculation on both sides. I don't know. I'll let Ian answer that question later on. When it comes to the USMCA or the new NAFTA, you know, there was a long process, and here in Central Ohio, what's interesting is we do have a lot of automotive industry, which would have significantly been impacted and still will be impacted by the new trade agreement, and specifically the regional content rules that are within that agreement. And so that, I think everybody sighed a bit of a relief when there was an announcement that all three parties had come to an agreement, and that it needed to go through the processes of ratification. What's been interesting with that is everybody was on board. But now, since the midterm elections and the changeover in the House from Republican to Democrat, now there's a lot of speculation of, okay, is this actually going to make it through the approval process in Congress? And what impacts might that have on a final deal? And so I hope Ian talks a little bit about that in a little bit too. And so as we look forward into our crystal ball, what I can share with you is currently we have about 125 active projects in our pipeline. Again, a project is a company who has very detailed specifications on what their capital investment is going to be, what their employment numbers are going to be, and what their payroll is going to be. And so we're looking at a very robust pipeline. We'll see if these hold out, but depending on what happens with tariffs and trade agreements, we could maybe see, I don't know, a change in jet stream as opposed to a hurricane, or we could see a typhoon. So I'm not sure how that's going to go, but either way, at least currently we have a strong pipeline in the mix to help us out if all things go well.
All right. Thank you, Deb.
There you go. Good evening, everybody. Happy to be here again. I keep coming back, so there's good things to, it's a good audience. I do need to start with the regular disclaimer. This time I got a picture of my amazing building to distract you, but the views today are, of course, mine and not necessarily those of the Federal Reserve Bank of Cleveland. So you heard a lot about tariffs. You're going to hear more about tariffs. I'm going to talk to you about essentially the domestic economy in between them. And if we look at GDP growth, this has been a really solid year. At this point, we're coming in a bit above 3% if we kind of hold out and get even the, not terribly robust numbers that we're projecting for the fourth quarter. Now, a fourth quarter projection at this point, it's pretty thin on data. So it could really vary a lot, but, it's really been a solid year. Let's take a look at where that came from. So when I think about growth, one of the things that I'll show is typically where did the growth come from, because that can help us pin down sort of what do we expect in the future. So in particular, on this screen, it's kind of a brownish yellow. That's consumption growth. And consumption growth explained most of the growth that we saw in the past quarter. So it contributed that amount to our growth. Now, consumption is a good fraction of our overall activity, so it's 70%, and that should be kind of there. But it's also helpful because a strong consumer is a consumer who's likely to be strong in the upcoming quarter, too. So I would expect to see consumption growth continue on to be reasonably strong. Now, the opposite of that is inventories. So if you look at the second quarter, you can see that the second quarter we had a deficit of inventories. We have a surplus of inventories now. Some of that is in soybeans, which you did already hear about. And then the green one here is net trade. So we saw a net trade reduction, and you might think, okay, now I'm seeing real trade effects. Not really. So that was, we sold extra soybeans in the second quarter because you couldn't sell them in the third quarter, so we have less agricultural exports. But we aren't really seeing a sort of long-standing, this is going to be the upcoming future of trade yet in the GDP accounts. So I mentioned strong consumers. We like to look at the consumer sentiment. It measures what people intend to do based on their own household circumstances. If I look at either of these two numbers, they're kind of at or above the whole business cycle of the last expansion. So we're in a really very good place as far as consumers are concerned. That said, we are seeing elements of our economy actually slowing down. So we are seeing residential investment slowing down and being essentially zero on a year-over-year basis now. Now that may be surprising to you here because this is a relatively hot housing market. But nationally, we are seeing housing slow down. We're seeing less construction. There's rising prices. We are seeing interest rates starting to cut the affordability of housing. And then, of course, when you think about the big picture, you don't want to ignore the financial markets. And for those of you who have money invested, it's been a volatile period of time. And we do pay attention to this. And the reason why we pay attention to this is it fits into our forecasting model. Nothing works unless it works in that forecasting model, and it works. So when you think about stock markets, I want to say, okay, well, that is predictive of future growth. So how concerned am I about today? Not that concerned yet. I mean, it's a worry. But when I'm thinking about a forecasting model, I need a whole quarter of reduction. And while today wasn't good, the day before was good. And we need, it will work itself out. And if we end up with, sort of a significantly lower stock market at the end of the year, then we are going to think, okay, that is going to serve as a damper on growth. But if it just reverses, as it very well may, then it will show up as nothing happened in the quarter in the financial markets. Now, over time, you can see that the interest rate markets, so the treasury markets, have been, considerably less volatile. They, by treasury market standards, have had a little volatility, but it's nothing compared to the stock market. So it's really primarily about what do we think our companies are worth. So if you pull all of that together, you're going to end up with an outlook that has an interesting little bump in it. Right now, our expectations and the expectations of the Federal Open Market Committee, who set interest rate policy, is that this year is going to come in really solid. And in fact, the median is above 3%. But that said, the expectations for next year are still growth, but, probably at a slower rate. And that is, some of the slowing that you were seeing in some of the components. But still not a bad rate, because I always want to point out on the far right-hand side of this graph is the longer run rate. And the longer run rate is what we consider the economy to be running at a sustainable rate, where it's not going to be reducing or increasing the unemployment rate. It's just going to be moving along. And even next year's growth rate, while slower than this year, would still be above that. So we still have a tight environment. And that is very much showing up on our employment picture. When I was looking back, the first time I came to speak here was in 2009. And I was definitely highlighting the fact that we needed to see a lot more progress in labor markets, and the Federal Reserve was not going to stop policy until we did. Well, we're out of that mode now. We've been out of it for quite a while. We've been seeing very consistent growth. With the last month, we've got 200,000 jobs, month on month for 3, 6, or 12-month averages. That is a really robust rate of job growth. That is showing up as driving our unemployment rate lower, because we don't have 200,000 new people in our economy every month. We're just not at that rate of growth of population. So we're driving down our unemployment rate. It's now at 3.7%. I thought I'd show a couple other ones that might be more relevant in the crowd. So let's take a look at 2 others. One is the unemployment rate for 20 to 24-year-olds. You'll see right away it's higher. Of course it's higher. But I want you to look way over there, and the unemployment rate for 20 to 24-year-olds is as low as it's been all the way back to about 2000. So this is a really excellent time to be a senior. And I hope it's good for the rest of you too. On the other side, I want you to look at the unemployment rate for college graduates. And this is why everyone kept encouraging you to go to college, because the unemployment rate is a lot lower for college graduates. And again, just to make that point, it's right down to kind of the low levels that we've seen in past expansions. Looking forward, the FOMC has been looking at this and saying, okay, well, we've been seeing progress in labor markets. We're expecting more growth than we can normally sustain. So we expect the unemployment rate to continue to fall, but not by that much. So there is no question there is a 0% natural rate. It can't possibly be any lower than that. So we are kind of getting into the range where, we're kind of below what people thought the natural rate of unemployment could be. We're moved beyond that. As a labor economist, I would say, yeah, that's what we normally do. We normally go straight on through that thing. But at this point, the FOMC is expecting the natural rate to be more in the 4.6 to 4% range. And we'll see some of why that is. Because I always try to come and say, okay, what's really the key topic right now on the minds of people who are looking at policy? And right now, it's about wages. So let's talk a little bit about compensation growth. That's the more technical term. Wage growth. How is it evolving, and what should we be expecting here? So I want to point out a couple things. I got a long series here. This is basically from when the data started. And one of the nice things about the Employment Cost Index is it includes everything. It includes the fact that you've got a vacation day. Treats that as money. It's a benefit. It includes the fact that my employer paid taxes on my behalf. Social Security taxes, the employer share. It includes that. It includes health care. It includes retirement, everything. So you can see that in the 2004 period, around then, we were seeing really pretty strong benefits growth, and that was really boosting compensation. And that meant that employers maybe were putting a little less in the wage pool. But in this expansion, we really, other than the first little bit there, we really have seen wage growth and compensation growth be roughly equivalent. There's no extra thing going on in compensation now. And of course, it does look a little lower. But I want to put that lower in perspective. So I'm going to take that exact same data, it's all on wages and salary, and I'm going to ask, okay, how has it evolved since the recession? So 0 here is going to be the start of the recession. So in the most current example, it's in 2007. But we're going to use that 0 date for each one of these expansions. What I want to point out here is that, put on this basis, you can see that the wage growth in the light blue line, that's this expansion, is about a percentage point lower than the past two. And that's kind of where our low wage growth comes from. I do also want to point out that while it is low, that the pattern has actually been, not that atypical. If you look at it, when you get to the recession, compensation falls. It's still growing, but it grows at a slower rate. And that's this fact that, out to 6 to 8 quarters, 2 years there, you're going to see that number coming down in each one of these cases. And then, interestingly enough, it tends to go flat. So then we're not actually really booming. The economy is moving along. Compensation growth tends to be steady. And only towards the end of the expansion do you see it start ticking up. But right away, I want to point out that, in each one of these cases, that pickup, that acceleration is still pretty gradual. Compensation is something that businesses are really kind of slow to adjust. Let's look at the unemployment rate for those same episodes. So I'm going to do it the same way where the start of the recession is 0. And of course, on unemployment, that's a really easy thing to see. That's when things were good, and then the unemployment rate rises. And of course, in the last recession, it rose a lot and was almost as high as it was in the early 1980s. Now, at this point, you can see that they've all come down, and they all go down as the expansion continues, but we now are at the lowest unemployment rate of this set of cycles. But, we're not as out of the ordinary as you might think. Now, just to show you that, hey, labor markets, that supply and demand thing that they teach you when you first start, it's still kind of working here. So I want to point out that I'm going to compare unemployment rates and wage growth. So I'm going to think about a market that we care a lot about. And I'm going to ask what happens when unemployment rates rise. Now, when you compare occupations, they have very different unemployment rates. So I'm setting the unemployment rate to be 0, and then asking how much does it go up from when the recession started. So if I look at the first category, which is service occupations, it goes up 4 percentage points. What are service occupations? Well, they're actually a lot of retail occupations. They include the fast food restaurants. It's a relatively low-paying occupation. One of the things I want to point out, though, is at this point, it is seeing the fastest wage growth of any of the sort of big occupational categories. So our low end of the distribution is seeing gradual wage increases, and they're up to like 4% now. So we are seeing the fact that, if I'm looking for service occupation workers, the starting employment side, I'm looking at, 2% less than I had at the beginning of the recession. So I'm really have a tight labor market there. And it is really showing up in, wage growth picking up. The other one I want to show is production, transportation, and moving. And so this is, again, a very blue-collar sort of occupation. And you can see right away that the experience in a recession is very different if I'm in production. If I'm in manufacturing, things go bad quickly. They actually recover relatively nicely, but they go bad very quickly. And again, we've been seeing for quite a while now wages actually picking up as those labor markets really have tightened. But it takes kind of a long time. So we're in the phase now where you're looking at compensation growth now sort of gradually picking up and being part of our inflation picture. And that's okay, because our inflation picture is still very, very steady. We're looking at 2% inflation over the last year. That 2% level is just dip back down there. Energy prices are certainly going to be a factor in that. And now we're looking at energy prices coming in even lower. So it's likely to go below 2% in the coming months. The FOMC is expecting inflation to continue around 2%. And we expect that to continue on for the near foreseeable future. So what about today's policy environment? So not my building, but the big one in DC. It is a combination of achieving maximum employment and price stability, and of course we're doing pretty well on both of those. We're at or near full employment. Inflation's about 2%, and we're projected to grow further. It's that projection for further growth that drives sort of what happens with interest rates. So a lot of people are asking, well, how much should interest rates go up from here? Some people have questioned that. But you know, at this point, we're looking at a picture where we're expecting interest rates to gradually rise, nothing really shocking here, to gradually pick up as growth picks up, and be in about the 3% level at the end of next year. Now, I put up all the dots there. What are all these dots? These dots are every single committee member. So one committee member is expecting inflation to be over the Fed funds rate to be over 3.5% in the coming year, while other members are expecting it to stay closer to 2. There's uncertainty there, and there ought to be, because the outlook is uncertain. But on balance, the committee is expecting that interest rates will rise to about 3% in the coming year, and that's a pretty moderate and slow rise. So I'm out of time, and I want to respect that, and I will just leave this slide up here. It's got all the things that I've already talked about.
Mark.
Okay, thanks very much, Goran. Thanks for inviting me up again. I don't think I've been as many times as Mark, but I'm glad to be on the team again. I've been a trade economist for getting on for 35 years, and I was at a conference in Washington over the summer, and normally this would not be a particularly well-attended session of the conference because trade economists kind of figured that we had all the problems figured out, we knew trade was a good idea. And then the current administration came into power in 2016, and suddenly I'm relevant after 35 years. So I'm going to talk a little bit about where I think US trade policy is currently headed. So first of all, and I've been writing with a law professor friend of mine at Ohio State about, we're writing in law journals where you're allowed to be a bit more polemical than you are in typical economics journals about what is driving US trade policy. So if you follow these things, the administration has essentially expressed the view that international trade is a zero-sum game in the sense that there are winners and there are losers, and you'll hear both the president and Lighthizer, the US trade representative, and Peter Navarro, the president's trade advisor, using this language. And Adam Smith, I thought, had debunked this idea in The Wealth of Nations in the 18th century, this idea of what was then called mercantilism, but apparently mercantilism's made a bit of a comeback where imports are considered to be a bad thing and exports are a good thing. Of course, what this implies is that there are no net benefits at all to being a member of the global trading system. And at the same time, the trade deficit is seen as clear evidence of this zero-sum game. And you'll hear the administration using language to the effect that because we run a bilateral trade deficit with China and we run a trade deficit overall, that somehow the US must be losing and our particular trading partners must be winning. Having said that, there is, I think, a totally legitimate objective of the administration, for which I think there's bilateral support. Deb, you might know more about this than I do. And I think there's also global support. There's a recognition that there's a need to get China to reform its economic system in a way that stops discriminating against foreign firms. And here I'm thinking particularly of the way that if you want to sign a joint venture in China with a Chinese firm and you own technology, very often you, or at least historically, have been forced to transfer that technology through joint ventures, as well as this issue of state-owned enterprises subsidizing firms and the theft of intellectual property rights. So I think this is a legitimate reason to be thinking about trade policy with respect to China. So this is not a scorecard, this is just a report card of the trade actions that the administration has taken. When the administration came in, the first thing that the president did was basically say, we're out of the Trans-Pacific Partnership. This was a partnership and a trade agreement agreed in 2015 between 12 member countries. It included countries like Japan, Canada, Mexico, New Zealand, Malaysia, etc. The remaining 11 members are now officially going to sign the CPTPP. By the way, if you work on free trade agreements, you have to get used to a lot of acronyms. This is the new version is going to be signed in December, so that'll account for about 13% of gross domestic global GDP. Secondly, the administration has imposed broad-based tariffs. By broad-based, there are no countries that have been exempted from these tariffs on steel and aluminum. By the way, I'm British, and I've learned to say aluminum as opposed to aluminium, which is tough. These tariffs were implemented on the grounds of national security, which in my view is a very bogus argument for these tariffs. Just so that you know, China only accounts for 6% of US imports of steel. Most of our steel comes from our northern partner in Canada, and that's certainly the case in aluminum. Third, we have renegotiated NAFTA, as the economists called it, NUFTA. You're supposed to laugh at that. Yeah, very good. It's been renegotiated as the USMCA. Pretty much the key change to this is the rules of, Deb mentioned this is the rules of origin, or what content of an automobile sold in North America can go across borders at zero tariffs, has to contain a certain number of intermediate inputs manufactured here in the US. So we've raised the domestic content rules on automobiles. We've also been escalating the trade war with China over what I described as these unfair trade practices. And this hasn't actually happened yet, but the president has initiated an investigation, again on national security grounds, into US automobile parts and automobile imports. And there's a potential for 25% tariffs, ad valorem tariffs, being implemented on imports from our key allies, which I think is very concerning. So what's been the path to the trade war? So as a trade economist, I thought trade wars were a thing of the past. I'm way too young to remember the Smoot-Hawley Tariff Acts, and I doubt whether there's anybody in the room who's old enough to remember the Smoot-Hawley Tariff Acts actually being implemented in the 1930s. But we're heading in that direction. We've gone beyond the normal kind of spats that you have amongst partners over trading issues. We're getting back towards what economists would call the non-cooperative equilibrium, certainly between the US and China. This kind of began in a fairly limited way. The US implemented tariffs on solar panels and washing machines, and China immediately retaliated with about 180% tariff on imports of sorghum. That was back in January. The US then implemented the steel and aluminum tariffs. That was in March, and then were finally implemented in June. And we've seen retaliation by China on goods like pork, the EU on Harley-Davidson motorbikes and bourbon, and Canada on steel and aluminum goods. But you can see in that little table below, I won't push through the numbers, we can talk about those later, but the trade war with China is being ratcheted up through a series of phases. April, the administration decided to impose 25% tariffs on $50 billion worth of trade with China, mostly on intermediate and capital goods. China immediately retaliated with $50 billion worth of trade affected by tariffs, notably soybeans, automobiles, and aircraft, are three most important agricultural export sectors to China. The US then retaliated again in June with initially 10 to 25% tariffs, this time on a range of intermediate and consumer goods. So these tariffs are going to start to hit consumers in their pockets. The Chinese again retaliated, and so on and so on. And so this is the nearest I've seen in my lifetime to a real trade war. No doubt I'll be writing papers till the end of my academic career on this. What are the costs of the trade war? These are just a few bullet points. Economists haven't had the time or the ability yet to really evaluate the effects of these tariffs, but just to give you a few examples, Harley-Davidson has now shifted its production, some of its production overseas because it exports to the EU. The EU had implemented a 31% tariff on imports of Harleys. So Harley has had to move production offshore in order to get around those tariffs. As Deb mentioned, we've seen a significant reduction in US soybean exports to China. Wally Tyner, who's a colleague of mine at Purdue, is predicting if these tariffs remain in place for more than a few years, we could lose up to 9 million acres in soybeans to the Brazilians, our major competitor. Here's a graphic here. The upper lines up here, these are previous marketing years. Down here, this is how much we've sold to China since the marketing year began in September. Right now, we're looking at the beginning of November, soybean sales to China were down by 94% compared to a year ago. Now, back up. We're supposed to gain about $450 million worth of trade with our northern partner and our southern partner, Canada and Mexico, but this will be matched by $7.9 billion worth of losses because of retaliation through tariffs against agricultural exports from the US. And this is another study out of Purdue University. If automobile tariffs are implemented, some colleagues of mine at the Peterson Institute have calculated because of the value chains, this could mean up to 195,000 US jobs lost in the automobile industry. If our foreign partners retaliate, that could be up to 625,000 jobs lost in the automobile industry. So this is entirely counterproductive to implement these kinds of tariffs in a system that's so sensitive to the value chains. Finally, even though Mark pointed out that US economic growth is chugging along, well, it's not chugging along, it's moving along rather nicely, the IMF in their outlook this year has forecast if the trade war continues, we could lose $430 billion worth of global GDP in a global economy that's actually quite soft compared to the US economy, and they forecast that the US is particularly vulnerable to a downturn in the global economy because of this trade war. So let me talk a little bit about the US trade deficit. We've actually run a trade deficit since the early 1980s. Now, you'd think with the administration, it's clearly a case of never let the facts get in the way of a good argument. So the red line is the goods and services balance, and the blue line is goods on its own. So you can see that we run a very large current account deficit in goods alone, but we have a services trade surplus, and so the overall balance of payments trade deficit right now, as I did the cumulative numbers today, is running at negative $445 billion as of the end of September, and we were running last year, at about just over $600 billion on the balance of payments, the current account. So we're running a pretty large trade deficit, although you can see that during the recession, international trade sort of fell down a hole, and we came out of the trade deficit a little bit, but we've basically been running a trade deficit since the Reagan administration. So economists all agree, and if you've done Macroeconomics 101, you would understand this. The trade deficit is driven by a decline in the national savings rate. US households have a very high marginal propensity to consume. 70% of GDP goes into consumption. And the US government has a high propensity to run fiscal deficits. So we have very low national savings rates. The trade deficit will continue unless savings increase and/or investment falls. This is a fundamental result from the national income accounting identity. Any increase, and at the same time, any increase in the government's budget deficit, the fiscal deficit, simply feeds back into more consumption, be it through personal consumption, investment, or government spending. Aggregate demand exceeds aggregate supply. There's only one place for it to go, and that's into imports. Exacerbated by the fact, what did Mark tell us? The US economy is running at full employment. The only place it can go is imports. And if at the same time that the US government is raising interest rates, what happens to the US dollar? The dollar appreciates, exports go down, imports go up. So this is policy incoherence, in my opinion, on the part of the administration. There's a graph to prove to you. Here's the US current account. This is as a percentage of GDP since 1980, running very negatively. Look what's happening. US savings is running continuously below investment. That's that idea that we're saving less either as a government or as in private savings. So trade policy will not fix this problem. Economists agree on this. Bilateral trade policy, be it with China, Mexico, Germany, Canada, you name it, will simply do what? It will divert trade to other sources. I'll give you an example. China has slapped a 25% tariff on imports of soybeans from the US. Brazil, that trade has simply been diverted to Brazil. It's a bit like playing whack-a-mole at the county fair, right? Just think of that analogy. Secondly, tariffs reduce imports, so we in the US will reduce our imports. What will we do? We will look, by lowering our imports, we reduce our demand for foreign currency. There are less dollars in the international currency market. What does that do to the dollar? If you have less dollars floating around, the dollar appreciates, you get exactly the same problem. Exports decline, imports increase. Essentially, the trade deficit is a macroeconomic phenomenon that can only be solved by macroeconomic policy. And I'll give you some policy choices there. We can talk about these later. They're probably not very popular with many people in the audience. Tax consumption, a VAT. I know taxing, that sounds like socialism, but we can talk about that. Reduce the fiscal deficit. That means cutting the US budget deficit. Depreciate the exchange rate. That's another possibility. Tax capital inflows. These are suggestions not by me, but by people who follow these things. Caroline Freund, an economist at the Peterson Institute. So my concluding thoughts. Trade is a positive-sum game. There are net benefits from international trade. This is the most recent number I could find for the US. Since 1950, this is in 2016 dollars, we've had a cumulative benefit of $2.1 trillion to US GDP. That's a paper by Gary Hufbauer and his colleagues at the Peterson Institute. Import tariffs will not solve the US trade deficit. I don't think you'll find a reputable trade economist or macroeconomist who believes this is going to happen. There are, however, legitimate concerns about trade with China. I mentioned the theft of intellectual property rights. This is a lower bound number from the US Trade Representative's Office of $50 billion a year lost intellectual property to the Chinese. Therefore, the US and its allies should put pressure on China to conform to the rules of the WTO. Remember, China acceded to the WTO in 2001, and when it did, it signed an international agreement on protection of intellectual property rights, and it also, in acceding to the WTO, agreed not to try to force technology transfer to any multinational firm investing in China. Now, they've got really clever ways of getting around that, but they are definitely doing it. However, we've slapped tariffs on our most likely allies to help us at the WTO, and what have they done? Of course, they've retaliated against us. And finally, and this is something as a trade economist that I am actually really concerned about, US trade policy, I think, represents a serious threat to the post-war international consensus on trade rules as set up originally in the General Agreement on Tariffs and Trade in 1947. We've had 9 rounds of tariffs. We've lowered industrial tariffs on average to 4% amongst the developed economies. We've seen a significant increase in global trade correlated with international economic growth. And there's a real risk that the administration would seek either to ignore the rules of the WTO or to actually pull out. And I looked at a study the other day that said if we were to pull out of the WTO, and by the way, Britain faces this problem too because of the idiocy of Brexit. I'm allowed to say that because I'm British. The pound rose today because apparently they've reached an agreement, so I'll believe it when I see it, on Brexit that is. But the WTO, if we got rid of the WTO, or we pulled out as the US, we would go back to our bound tariffs that we set in the Smoot-Hawley Tariff Act. This would be the largest average increase in tariffs since the 1930s. So on that rather pessimistic note, after my optimistic friends over here, I'll finish. Thanks very much.
Well, before we open the floor to the audience and questions, I would like to ask any of the panelists whether they had a quick question for each other, or all of each other.
Always available for the questions. So, Deb, We saw the Amazon headquarter decision just come around, and of course, many Ohio cities made an effort at Amazon HQ too. What did we learn from that?
If you could use this.
Sure. Well, I will tell you that just from our organization and participating in putting a proposal together, and I obviously can't talk in detail very much about the proposal or anything of that sort, but what I can share with you is we found that even though the Columbus region has a lot of strengths, there are still weaknesses that need to be improved upon. I can share with you that we're much better as a collective whole working with our partners than we are individually. There were many, many different organizations that worked together with us and partnered with us on the proposal itself. And what we've learned from an economic development standpoint is there's no reason why we should let some of those ideas that we had and put forward with in the proposal to sit and wait for a next proposal. Let's start to implement some of those policies now to help us win the next competition. Sorry, that wasn't very specific, but we certainly learned a lot from going through the process.
I'll offer Ian a question too. So you were a little more pessimistic this year for good reason. So I'm curious, what's your sense for the likelihood that the current trade situation would become a recession, lead to a recession?
Well, that's a good question. I mean, whilst the economy's humming along, it's hard to believe that it's going to have any effect. But I think if I understand what I see in the the forecasts in the financial press, that most of this GDP growth, and I think you pointed this out, has not been through investment in productivity raising capital investment. It's mostly been through consumption, and I think that's going to eventually wash out. So I think all things being equal, no trade policy, I think growth would start slowing down. I think the risk that we run is that the Eurozone is still quite fragile. Chinese economic growth is slowing down. I mean, slowing down 6% as opposed to 7.5%. But as the Chinese economy adapts to being, a middle-income economy, starting a trade war when, they're switching their growth model to one of being more consumption, less savings, less export-led, pushing them to be more inward doesn't seem to be a very appropriate policy choice, given that American firms are not just American firms, but many multinational corporations are seeking to invest in China and take advantage of the way their economy is changing. So I think it's going to take a while for this to kick in. I think the one thing I would point out on the consumption side here is that the second and third tranches of tariffs by the administration are much more targeted at consumer goods. We're talking about nearly 5,000 lines in that phase 2 of tariffs. And I think what's really, when we think about trade and the benefits, trade generates benefits to exporters. It generates competitive effects on import competing industries, but of course it benefits consumer purchasing power. And one thing that we do know from economic research is that people in the lower end of the income distribution disproportionately benefit from trade. The work by Fagelbaum and Candlewell that was published in the Quarterly Journal of Economics a couple of years ago showed that people in the bottom 3 deciles of the income distribution get about 68% of the benefits of free trade. So if we start moving the system closer towards not autarky, but certainly in more of a closed economy, these are many of the very people who voted for the administration, and it's really going to hurt them in their pocketbook. So I think you will see a slowdown in consumption and maybe GDP. I'm not sure I'm going to forecast effects on employment, but I guess if the automobile tariffs go through, and Deb, you would, here in Central Ohio, we'd be very worried about those tariffs going through, given the production of intermediate inputs, and as well as automobiles up in, Marysville for sure with Honda.
It would certainly have a significant impact, both on the OEMs and the supplier base.
Mark, I'm not sure you can answer this question, but I'm going to ask it anyways. And if you can't answer it, I understand why. I'll try to say this as diplomatically as I can. So the central bank, or the Federal Reserve, is clearly, since the Volcker years, has been a very independent institution. How concerned are you about the administration, and I'll just use that language, politicizing the role of the Federal Reserve through commentary about interest rates?
Well, I would just note that it's not the first time that it has happened, that there's been political concerns around the Fed. In the late 1970s, there were many protests for the high interest rates at that time. It was not coming from the White House, but we're in a different environment, and the Federal Reserve's responsibility is to act independently, and I think we're doing everything we can to maintain that. And we do have some nice built-in features. So the fact that we have the districts has meant that there are fewer appointments. It is a system that was designed to help support independence.
Can I just, and I'll ask a follow-up question. I think we're forecast to have, it's $1 trillion fiscal deficit in 2020.
It is.
What kind of pressure is that going to put on if the economy's slowing down, but we're still running that kind of deficit, what kind of pressure is that going to put on interest rates, do you think?
We've been seeing interest rates rise. They've been pretty gradual. I think one of the things that I've always said about trade deficits is that there's a balance thing going on here, and you can't sort of easily shift things very rapidly. So it depends on how much our foreign trade participants are interested in buying U.S. Treasury bonds. Right now, there's a lot of demand, which is showing up in sort of why you see the dollar appreciating. But yeah, it's an environment and a risk, and I applaud your pointing out the risks associated with tariffs.
I mean, we're running a negative net investment position, which I think is getting close right now to being 45% of gross domestic. So yeah, we're very good at selling our assets to foreigners, and so they have claims on our financial system. But we're getting close to 50%, which many economists would consider, at least for many emerging economies, would be a very dangerous place to be. And if we have right now the dollar's the global vehicle currency, so as long as and treasury bonds are the nearest to a risk-free asset in our models, right? But economists like Philippe Gagnon and others at the Peterson Institute, Morris Dobbsfeld and Ken Rogoff of the IMF, both worry that if we have a sudden currency depreciation, this causes a huge inflationary shock in the U.S. economy. Do you think about those problems, or?
We do think about them. They are risks. They're not part of the central part of the outlook. I think it's very important when you think about those debt level thresholds to recognize that the U.S. is not that emerging market country, and that the dollar being the primary currency for all sorts of different kinds of trade and all sorts of activities which are beyond the U.S. borders kind of limits somewhat how we could depreciate.
Well, at this point, I would like to open the floor to questions. If you have a question, please raise your arm, and you're going to get a microphone because we need this for the web streaming, so they can hear you.
Okay. Hi. My question is for local government and how you talked about the job rates being up, even though your project numbers are about half of where they were prior. Do you expect that downward trend in your project numbers will plateau the job rates here in Columbus in the future years?
Yep, thanks for the question. What's been interesting about the job numbers that we've seen this year is while the project numbers are down, what we're seeing is larger projects that are coming here. So that's actually causing an increase in the total amount of jobs that are happening. I don't know, I mean, you know, with 8 years of history, this is the first year that we've seen that happen. So our average project size when we looked at it this year was around 144 jobs per project, where in past years it's been around 50. So I don't have the crystal ball to answer where we're going to see that in the future. What I can tell you is because we have appeared on lists like being chosen in the top 20 cities that were under consideration for HQ2, that's really risen our visibility around the world. And so I think that we're being considered for more projects of larger size than may have considered us in the past. And that may be why we're seeing that larger job number.
Okay, so like, if I'm getting this right, you're saying the spreading of Columbus and the urbanization that's still going on will most likely still have those greater job numbers being offered in your projects.
I think that we're going to continue to see projects of larger size interested in the region, yeah.
The question for the three of you, and in particular, because you were talking negatively about the U.S. money, and I don't know whether you remember or not, but in March of 1980, interest rates were at 20.5, and average deposit rates were at 15 with 3-year maturity, so that when it started to come down, that's when the shift happened with money in particular in the United States, is it got inverted, that the savings rate was higher than the lending rate. So we were able to survive that extreme pressures and not lose anything. And the other part about it is China, they're probably the single largest holder of cash, United States money, than even the Federal Reserve. So I guess you talked about that, and I guess it's not, to me, something that we can't withstand, and I just was wondering if you were able to talk to, as rates were to go up or the cost of money was to go up as well, or the cost of borrowing were to go up with that much of a differentiation. And we did have a slowdown in 84, 85, 86 when we had the see-through apartments in Boston, Dallas, St. Louis, a few other places along. So I just wondered if you could speak to that anomaly that happened over the course of 1980 to 1984 and then what you're seeing now.
Well, it was, yeah, so, I think we're in a very different environment than that. So, I mean, that was a high inflation period. It was definitely the case that banks were very much squeezed because they had limits on what they could actually charge as interest rates, they could pay as interest rates on certain things. So we were in a very difficult time that causes this sort of imbalance to start. But I think, I wouldn't look so much at that period. If I was thinking about the sort of big trade imbalance, I would look later in the data.
Yeah, and the point I was making is that the trade deficit, the current account deficit, is mostly being driven by the fact that two things. One, savings rates have been declining, but perhaps more importantly, savings rates are lower than the rate of investment. And if that's the case, then the only way the balance of payment, remember, the balance of payments, which is distinct from the trade deficit, has to balance. It's an accounting, you have two sides to the ledger. So the outflow of funds because of imports exceeding exports several things would have to happen for that to be brought to the balance of payments to balance. One is the dollar would depreciate, and that's typically, for most economies on flexible exchange rates, that's how the trade balance balances, because the dollar, your currency depreciates, exports increase, imports decline. Or the central bank has to use foreign exchange reserves to pay for that difference. In the case of the US, as you pointed out correctly, foreigners, the Chinese, the Japanese, are willing to hold US financial assets, which leads to, we have a positive flow of income coming in on the capital account. And that's the only reason we're able to run such a large deficit is because of those inbound flows of capital. The point that Mark and I were talking about is that the cumulative amount that we now owe to those who have foreign claims on US assets is that it's reaching a point where if the Chinese economy, for example, becomes the largest economy in the world, the renminbi, the Chinese currency, becomes the global currency, there's a risk that there's a big shock to the dollar. And when you get a fast, rapid depreciation, and these economists at the IMF have talked about you would need at least a 33% depreciation in the dollar to get rid of the US trade deficit and on the current account side and rebalance on the investment side. That would be a significant shock to the US economy, which would lead to very strong inflationary pressures. And that's why some economists are arguing that we in the US need to start considering a managed depreciation of the dollar, but at the same time, you have to cut the fiscal deficit, because if you don't cut the fiscal deficit, interest rates start to creep up. And so you're sort of leaning into the wind where you're trying to bring down the currency, but interest rates are pushing it up again. So I think what happened in the 80s is very different to where we are now. And the trade deficit hasn't got any better. I mean, it hasn't been positive. The current account hasn't been positive since where my data began. And that's mostly driven by this savings investment relationship. Aggregate demand exceeds aggregate supply. It's that simple. Sorry for the lesson in macroeconomics, but apparently, oh, no, I'm not going to say what I was going to say.
Right.
So appreciate the commentary on tariffs and how it's been semi-isolated into pockets and industries so far, and the magnitude has been varying across industries. And this is probably more towards the macroeconomic and global side, there's been much thought in the search for yield over the past 7 to 10 years in the corporate credit spreads compression. So now in seeking yield, the rates on corporate credits have compressed immensely. And do you see any bubble or risk there?
So the post-financial crisis, we spend a lot of time looking at all sorts of financial market indicators to see whether we think there's any sort of tendency to bubbles. And this is one in which I'd say, there's no question that spreads are compressed relative to where they were in past expansions. But I wouldn't describe it as a bubble. I mean, so would someone lose money? Yes, someone could lose money. That's not the same thing as a bubble where when you start to lose money, you start to question the value of the asset. When you question the value of the asset, then you start to lose more money. And there's more of a feedback mechanism. And in this market, I don't see that sort of feedback. But, are people potentially going to lose money on various fixed rate assets? Possibly.
I'm afraid that's something about which I don't know anything, so no comment.
Are there any other questions?
On that question, actually, I'll note one other thing, though, because, that sounds a little alarming. But, these claims that we were going to lose a lot of money on fixed-rate assets or fixed-rate asset holders were really going to lose their shirt have been going on for a long time now. And on balance, they've actually not proven to be that overly optimistic. So there's room to think, if I knew how it was going to go, then I would definitely be, taking a particular investment strategy, and I probably would not be doing economic outlook talks.
If you're so smart.
If I'm so smart, I would, no. I mean, it's any other market. It is a market. I mean, I do look at it and think, well, that's a pretty optimistic path for interest rates that's got to be built into that. But I mean, on balance, they actually have proven to be more or less right through a fair amount of this expansion.
Bill. All the panelists, I guess.
Assuming we get a more fact-based trade policy, say maybe picking a year at random, 2021, how durable do you think the damage that has been done and will be done will be? Will we be able to recover from this, and to what extent?
That can go first.
So my first comment is, it depends on the industry, I think. When we specifically look at soybeans, it's, if somebody else is servicing that market, I see that hard to gain that market share back. If it's something that you're looking at technology where it's actually a real value add, or there's a significant differentiator between what's available now, then I think that's a little bit easier. But I don't have just concerns necessarily about products or services on the surface. I also have concerns about the actual damage to the relationship that we have that's going to take a much, much longer time to repair.
I have spent the last 6 months thinking more about soybeans than I've ever done in my whole career as an agricultural economist. We did some number crunching at Ohio State where we said, what if the tariffs go out even beyond 2021? And we get the kinds of, so right now, American soybeans are selling at a 30% discount below soybeans coming out of Brazil. But we're not exporting anything. That would even get us into China, even including the 25% tariff. So we forecast for an 1,100 acre 50-50 corn-soybean rotation farm in the western part of the state, the main production part of the state, that farmers out there, even on not the most pessimistic forecasts about loss of market share, that they could average losses of net farm income up to 55%. And this is at a time when, over the last few years, commodity prices have been on considerable downward pressure. We have incredibly high yields this year, which is putting additional downward pressure on soybean prices. I don't know if you saw, there was a really good article in the New York Times, not last weekend, but the weekend before. In North Dakota, they can't sell soybeans, period, because there's no animal industry out there. The Seattle port is closed. They're not exporting anything to China. The transport costs to get them to the Gulf simply make it unprofitable. They're just piling up soybeans. There are soybean mountains that they're going to put tarps on, so there's probably going to be a huge amount of wastage. So just that one commodity, and I gave you a number, 9 million acres. So 1 in 3 rows of soybeans in this state go to China. We export $1.8 billion worth of soybeans to the world, a third of which goes to China. If the US alone stands to lose 9 million acres, if we lose out that market share to Brazil, and I think China, by the way, is trying to diversify its import suppliers. I think they're actually using this as an opportunity to further diversify their import choices. I mean, they're actually looking to Russia, believe it or not. They're growing soybeans themselves. They're reducing the feed rations to hogs in China. So that's a little bit too much Aggie for you guys, but that's what I normally have to talk about to the kinds of audiences I typically talk to. But I think the automobile industry is a really interesting example. So right now, the external tariff around the US on automobiles is 2.5%. We're raising the domestic content from 64 to, 80%. X number of vehicles have to be built where the income paid to the workers in Mexico has to be the U.S., the U.S. wage, or whatever that is. So that's going to raise,
16 is what they said.
I think at the margin, given the nature of value chains, I think you might see some automobile manufacturers simply offshoring from North America because they're just going to, they're better off paying the 2.5% tariff than they are the domestic rules of content. So I think the automobile industry, if the tariffs get ratcheted up to 25% by the US, this is going to have exactly the opposite effect to what the administration thinks it's going to have. That's every forecast I've seen from serious analysts of that industry.
I just want to make a comment too about the tariffs, because there was dialogue out in the news several months ago when the tariffs started to be implemented, that one of the reasons why the tariffs were being implemented was because Chinese companies should be building more product in the U.S. to service the U.S. market. So I was in China 3 weeks ago, and a lot of the conversation that I have around companies is, what's your U.S. strategy? When are you thinking about entering the U.S.? How are you thinking about doing it? And one of the things that I found very, very interesting in several of my conversations with companies was, we're not going to produce in the U.S. We're going to produce in Thailand, so we can still ship from Thailand to the U.S. and not have to pay duties and taxes, not the 25% that we have to pay now in sending it from China here. So the thought of having that investment come to the U.S. is somewhat backfiring in that investment then is now going to a different location in Southeast Asia to service the U.S. where there currently aren't tariffs.
Don't comment on tariffs, but eat more tofu.
I mean, Bill, just to give you another example, this is a Brexit example, but I think it's kind of so Airbus, which is a European, EU-wide conglomerate of the aerospace sector, in Britain they build the wings. They build the wings in the old factory where they built the Concorde in Bristol, in the southwest of England. They employ 10,000 people directly in the factory. And they have 100,000 workers who are dependent on the parts contracts with the production system there in Bristol. If we leave the EU, right, Britain leaves the EU, and it's looking increasingly likely, Airbus is simply going to shut down the plant and relocate. I think with these just-in-time production systems, the ability to move anywhere in the world, take advantage of low wage rates, modern communications. You used to have highly vertically integrated production systems in one site or in relatively spatially close areas. That's just been completely shattered in the last 20 years. And the interesting thing is that here in the US, we export a lot of that value added to start. So the canonical example is the old iPod. So the Best Buy price, 45% of that was just US patents, right? Just the technology. That was to design the computer code to make the processor work. That was offshored to Toshiba in Japan. And then the whole thing was assembled in China. Do you know what China's value added was on that iPod? 8%. So the trade deficit numbers are very misleading in some sense because, we're running this, a $300 billion trade deficit with China. A good deal of that contains value added that was produced elsewhere. So, even though China's moving to producing high-tech products, there's still essentially an offshore assembly plant, and they're getting into the lower end of the communications market, for instance.
Well, I had a question for Deb, especially that's talking to businesses out there. Are businesses considering this a temporary or a permanent change in the trade, how we do trade? What kind of response are you currently seeing of the firms?
So I think companies are when we look at the tariff situation, they're looking that this could be a long-term problem, and that's how they really have to plan and hope that it's a short-term problem. So, you know, they're evaluating, a lot of companies that I'm talking to that are evaluating the U.S. as a market are moving forward with the evaluation process, and then we'll make a final decision whether they actually make that decision to put production or distribution or technical centers here once they're through the evaluation, with no guarantee through the evaluation period that that's going to happen. But if they wait to see what policy is going to be, and the fact that policy changes on a fairly regular basis, then they don't want to find themselves 18 months to 2 years behind the planning process when they could have been doing it through the process and just made the decision at the last minute.
Are there any concluding questions? No? Well, very informative. Trade definitely dominated this conversation tonight, rightfully so, and it's in the news every day. If you see, there's no day that you can't hear something about trade going on. Well, I heard a lecture both about Adam Smith and Amazon. Adam Smith probably never could have envisioned something like Amazon existing, but both of them made it into the lecture tonight. Heard about hurricane tariff and hurricane trade agreement, about the zero-sum game, something for our economic students, non-cooperative equilibrium. I was glad to hear a technical term for an economist. So gloom and doom about trade, but a silver lining. If you like tofu, it has good times, right? For those that like tofu. So there's silver lining to everything. Students, hopefully you got a lot out of it. Economic students, we talked a lot about trade, about deficits, both fiscal deficit and a trade deficit, as we call it, twin deficits. I'm not teaching a macroeconomics course this semester, unfortunately. This is a very fruitful time to teach macroeconomics. There were years in the past I was teaching, there was nothing going on. Now a lot of it going on, and I'm not teaching it. So next year you'll get to hear all these things. Business students should have gotten a lot of it. But cost of production increasing for businesses, changing of supply chains as a response to trade. There are firms are looking at new supply chains, new relationships. This is theory to practice, what we say at Ohio Wesleyan. Thank you all for coming tonight. Thank you to the panelists, and we'll reconvene next year.